Well, with the world slowly going to hell in a handbasket, courtesy of one nation's desire to eat every strange animal on the planet, and dithering politicians without the intellectual ability to run a hot bath, the question that seems to be lighting up social media and anywhere else where traders and investors congregate is simply, where is the bottom? Or more appropriately, when is the time to buy? And as with all these plaintive cries into the wilderness, there is always some brave soul who will step forward and offer an opinion, no matter how irrelevant or silly. And I thought I would select one of these because it serves as a very, very good learning tool, because in very much a nutshell, it manages to encapsulate many of the things that traders or investors get wrong. And what prompted this video was simply this. This came from a posting that popped up for some reason on my Twitter feed. And it comes from Michael Batnick, who runs a site called The Irrelevant Investor. And the post is titled, "When is the right time to buy stocks?" And the post consists of a series of charts pointing out the bottom on previous bear markets, and then launches into this. And he says, looking through this, one thing is crystal clear to me. It doesn't matter when you buy, only that you buy. If you've been sitting in cash and want to buy but are worried that stocks will go lower, then break up your purchases. The math behind lump sum over dollar cost averaging has been settled. Yes, it has, but not in the way you think. But this is a time where emotions matter more than spreadsheets. He then goes on to attempt to support this argument with this particular chart. This particular chart presents a series of problems that I'll look at. The first is people are very poor at looking at data, because when investors or traders look at this, they will see, yes, there are bear markets, but the market always goes up. Okay, there's two problems with that to start with. The first is, this is the Dow Jones Industrial Average. It's an idiosyncratic measure of the market. It is not the market. And I'll talk about that in a moment. The second is the scale. Look at the scale at the bottom. Humans are very poor at making scale-based decisions. Time defeats us. And so to make this slightly clearer, what I did was take this time period, I incorporated the drawdowns, and I then looked at how long it took for the market to recover from each one of these drawdowns. So you can see, reading from left to right here, a series of blocks. At the top of the blocks is an arrow and a number. The number represents the approximate number of years it would take you to get back to break even if you had started investing at the time when the market collapsed. So you can see from early last century, the bear market they had there that began at about 1906 ran for 12 years. The collapse engendered by the crash of 1929 took 25 years to recover from. Even if you had bought in those intervening periods, you are looking at much more than a decade and a half in the wilderness where you make no money. The bear market from 64 to 83 took 19 years. The crash of 87 was an interesting thing as someone who lived through it, because the US markets recovered very quickly. It only took them 3 years. Post the dot-com boom and bust, 6 years. Post the GFC, 5. All of a sudden, we get a sense of context for how long markets actually take to recover if you use simply only the notion of the benchmark index. So simply the notion of saying that markets recover is an irrelevant one based upon the time it takes to recover. The scale of time defeats us. Even the most long-term of investors would begin to feel the pain after 6 years of no return. They would certainly feel the pain after 12. They would be near suicidal after 19, and after 25 years they would be living in a cardboard box under a bridge. This is the central issue, and whenever you go into a stockbroking or financial planner's office here in Australia, you will see this chart or a variation of it using the All Ordinaries. And the broker or planner will say to you, look, you just have to invest for the long term because the market always goes up. Bullshit. The index goes up because the index is an idiosyncratic aggregation of stocks that has an upward bias. Indices constantly churn their components, and this churn is continual. We can get a sense of this churn when we look at the components of the Dow, and the Dow's a very small index, and how they changed between 1929 and when the market began to recover. These are the components simply pre-crash, 29. And there's some names you might recognise, others you might not. When we fast forward to the period after the market had recovered, we see something different. Even the most cursory glance will tell you that some of these names are different. Something has altered. It is not a static entity. So if we go back to our original 1929 components, you'll see I've highlighted some of them in red. These are stocks that disappeared from the index between now and the later revision in 1956. 40% of the index disappeared. However, it's more complicated than that, because when a stock is removed, it is replaced, but it is quite possible for that stock that has been put back into the index to replace something else also disappears. So when we look at how this churn occurred and we begin to put things into context, all of a sudden you can see that even a small static index like the Dow churns. So you're not seeing a constant thing. This is known as survivor bias. And survivor bias catches traders all the time. And it really is a litmus test for defining who actually understands how markets work and who doesn't. If you have someone who makes these sort of statements without qualifying them with the notion of survivor bias, or alternatively, they make a comment that references something like downward volatility, you know you really need to examine very carefully what they're saying, because they're missing an understanding of the fundamental components of how markets work. So when you look at an index, when someone says to you, the market always recovers, here's the index, you look at that with a grain of salt and go, well, yes, the index does, but that does not mean that the shares that I bought will recover. And in actual fact, if you look at an index like our S&P ASX 200 and you compare the original components upon listing in 2001 to the components now, there's very little similarity. I think there's something like less than 11% of the index is still left from its point of origin. So you need to be careful about these statements about the index always recovers, you just need to buy. It's quite frankly bullshit. But the other point I want to touch on is the notion of dollar cost averaging. And Batnick said that the maths behind this has been sorted. Yes, it has. And as I mentioned, not in the way he thinks it has. The notion of dollar cost averaging, that is buying a proportion of an instrument at a given time in a given amount from here until the end of time, appeared in the literature many generations ago. And it wasn't met with any degree of skepticism or thought. Nobody actually thought. It's one of those things, sounds like a good idea, must be a good idea. Well, it sounds like a good idea, must be a good idea, right up until the moment you investigate it. Dollar cost averaging by itself is a topic unto itself, and there is too much to cover in the small amount of time I've got remaining. So I'll pop some links in the notes under the video where you can go away and actually read about what the literature says about dollar cost averaging and what testing says about dollar cost averaging. I'll spoil it for you here and now and give you the Reader's Digest version. It doesn't work. So we circle back to the original question. And the original question was, when is it time to buy? And that in and of itself is an innocent but valid question. Because everyone who has exited this market will be looking for a point of re-entry, some form of mechanism that says, go now. And there are a variety of ways that one can do this. Some very simple, some very complex. But all of them involve the notion that you're actually looking back in time, because you can only spot the perfect time to buy when that time is in your rearview mirror. But there are certain tools that can be used to assist. And the point I will leave you with is simply this one. And this is something you can think of for yourself and work out how you might work this out. It is time to buy when there are more buyers than sellers. And I'll add an addendum to that. It is time to buy when there are more buyers than sellers, and the buyers are more aggressive than the sellers.